Okay, now, my dear students, we will proceed for the next part, still in the chapter 4, foreign exchange market. In this part, in this video, I will cover the spot market and the forward market. Let's look at what we will learn in this video. Okay, basically, there are two types of forex market, which is spot market and also forward market. Let's look at one by one. The first one is spot market. If the operation of daily nature, it is called spot market or current market. It handles only spot transactions or current transactions in foreign exchange. Or the exchange rate that prevails in the spot market for foreign exchange is called as spot rate. Okay, expressed alternatively, spot rate of exchange refers to the rate at which foreign currency is available on the spot. The date of settlement is referred as value date. The rate used in the spot rate market is the spot rate, which is the spot bid or spot ask rate depending on the transaction done between the customer and the bank. Let's say, if the customer buys foreign currency, then the bank will quote the spot ask rate. If the customer sells foreign currency, then the bank will quote the spot bid rate. Okay, let's repeat. If the customer buys foreign currency, then the bank will quote spot ask rate. If the customer sells foreign currency, then the bank will quote spot bid rate. Okay, so here, how to buy or to use bid rate or ask rate, we will always look at in the point of view of the bank. Okay, the bank will sell the foreign currency, the bank will buy the foreign currency from customer. That's why they will use bid rate. And if the customer buy foreign currency, meaning the bank will sell the foreign currency. So the bank will quote spot ask rate. Okay, when the spot rates of two specific points in time are compared, the change in the exchange rates is often referred to as depreciation or appreciation of value of the currency. Okay, this one we have to recall back in the previous video. First, depreciation is when there is a decline in the currency's value, and the appreciation is when there is an increase in the currency's value. How to get the percentage of appreciation or depreciation? This one we had done in the previous video. New, this typo here, Malaysia ringgit per US dollar minus old Malaysia ringgit per US dollar divided by old Malaysia ringgit per US dollar times 100%, or E1 minus E0 divided by E0 times 100%. What would happen to traders of foreign currencies when the foreign exchange rates fluctuate from time to time? Okay, when the spot rates fluctuate, the traders, buyer and sellers of foreign currencies face foreign exchange risks. A buyer will make a foreign exchange profit when the foreign currency depreciates in value, and will suffer a foreign exchange loss when it appreciates in value against home currency. And a seller will make a foreign exchange profit when the foreign currency appreciates in value, and will suffer foreign exchange loss when it depreciates in value in terms of the home currency. For example, Okay, let's look at the example. The Malaysia Ringgit per USD spot rate is 3.0175 last week, and the USD appreciates to 3.0200 today. We assume that the dollar contract of USD 1000. Okay, from the buyer's point of view, last week he would pay 3,070 ringgit 50 cent for buying 1,000 US dollar. How to get this? Malaysia ringgit 3.0175 times 1,000. But today, in order to buy US dollar 1,000, he has to pay 3,020 because USD has appreciated. Okay? Meaning that Malaysia has depreciated. He pays more today in Malaysia ringgit when dollar appreciates, and this is considered as foreign exchange loss. Okay, do you understand? Last week, this guy has to pay 3,017 and 50 cent only. But today, because of the US dollar appreciate, meaning that Malaysia ringgit depreciate, so this guy has to pay 3,020 in order to buy 1,000. So this guy lost how much? 2 ringgit and 50 cent in order to buy $1,000. This one is a loss because foreign exchange appreciate. Okay, that is from the buyer's point of view. Now we look at from the seller's point of view. Last week, he would receive, the seller would receive 3,017 ringgit and 50 cent for selling US dollar 1,000. But today, he sells 1,000, he will receive 3,020 because US dollar has appreciated. He received more today in Malaysia ringgit when dollar appreciate, and this is considered as foreign exchange profit. Okay, from the buyer's point of view, when dollar appreciate, the buyer will experience foreign exchange loss. But from the seller's point of view, this guy will experience foreign exchange profit when US dollar appreciates. Okay, did you guys understand? That is the spot market. Now we move to the forward market. The forward market is an informal over-the-counter marketplace that sets the price of a financial instrument or assets for future delivery. That is why forward market. Forward market are used for trading a range of instruments, but the term is primarily used with reference to the foreign exchange market. It can also apply to market for securities and interest rates as well as commodities. A forward market leads to the creation of the forward contracts. Forward contracts can be customized to fit a customer's requirement and can be executed between banks or between a bank and a customer. The flexibility of forward contributes to their attractiveness in the foreign exchange market. If the forward market contracts are entered today, but the settlement are in the future, it is an agreement between a bank and a customer to deliver and pay a specified amount of currency against another currency at a specified future date and at a fixed exchange rate. The exchange rate used is the forward rate, which is fixed at the time the contract is entered to. The most common forward contracts are 30 days, which is 1 month, 90 days, 3 months, and 180 days, 6 months, or 360 days for 1 year delivery. Okay, banks will also tailor forward contract for odd maturities, 25 days, to meet their customers' needs. If a trader has a forward contract, the exchange rate that he would settle for his forward contract on the settlement date would be the rate at the time of contract is entered to, regardless on the spot rate on the settlement date. In this way, the traders will know earlier the amount that he has to pay or receive in his home currency when he buys or sells foreign currencies. Therefore, forward contract can be used as a hedge against foreign exchange risks, because the trader already knows the amount that he has to pay when he buy or sell foreign currency. In the spot market, traders will face with exchange rate risk every time the currencies appreciate or depreciate. Since the forward market, the exchange rate to settle the forward contract is the rate that is determined when the contract is entered, any changes in the exchange rate will not affect the trader of the foreign currencies. That is why we say that forward contract can be used to cover against currency fluctuation. Okay, this is the differentiate between spot rate and forward rate. Today, spot rate is Malaysia Ringgit 3.065065 US dollar, and 1 month forward rate is 3.061020. That is the rate for today. After 1 month, the spot rate would be 3.0700, meaning the rate has fluctuated. Malaysia Ringgit depreciate and US dollar depreciate. Okay. Given to traders who wish to buy or sell US dollar in 1 month. Okay. First, this is the first situation. If a trader wishes to buy USD in 1 month by using his forward contract, the amount of Malaysia Ringgit he has to pay is 3.0620, this one. Okay. A trader wishes to buy US dollar, so you have to use AS rate, because as I mentioned earlier, the which rate that you will use is in the point of the bank view, meaning that if trader wish to buy, so the bank will sell, so they will use AS rate. Therefore, that's why he has to pay 3.0620, this one, AS rate. Use AS rate because bank will sell. If he doesn't enter the forward contract, he has to pay 3.0715. Okay, this one. At the spot rate after 1 month. Therefore, in this case, the trader gain or make profit because he can buy US dollar at cheaper price by using forward contract. Okay, and then the second situation is if a trader wishes to sell US dollar in 1 month by using his forward contract, the amount of Malaysia Ringgit he will receive is 3.0610 per US dollar. In this case, we use bid rate because bank will buy. If he doesn't enter the forward contract, he will receive 3.0700 per US dollar at the spot rate. Therefore, in this case, the trader will receive less US dollar through the forward market because the USD has appreciated in the spot market. Okay, this one from 3.0610, the USD appreciated, meaning the Malaysia ringgit depreciated to 3.0700. So, for this case, the trader will receive less US dollar. Okay, can you see the difference between these two situations? Okay, please take your some time to understand the situation. This one wish to buy US dollar in 1 month, and for this one wish to sell US dollar in 1 month by using his forward contract. So they will get the profit or receive less US dollar through the forward market. Okay. Next, forward rates quotation. We have outright rate quotation. The forward rates are quoted in the actual figure. Example of an outright rate is spot rate is 3.063768 per US dollar. For 1 month, forward rate 3.085090 per US dollar, and 3 months forward rate 3.0725/78 per US dollar. This is outright rate. For swap rate, the forward rate are quoted in the point form. Example of the point rate is 3.0620/48 US dollar, and 1 month forward rate is 20/70, 3 months forward rate 75/20. Okay. If the forward rate is bigger than the spot rate, the currency is at forward premium. And if the forward rate is smaller than the spot rate, the currency is at forward discount. Okay, if forward rate bigger than spot rate, it is forward premium. Is forward rate smaller than spot rate, that is forward discount. Okay, let's look at the example. How to calculate the outright rate for forward contract if point rate quotations are given. Based on the example below, the swap or point rate quotation, the forward rates are quoted in the point form. For example, of point rate is 3.0620/48 US dollar. For 1 month, 2070. For 3 months, 75/20. So, to calculate the bid rate first, spot rate plus basis point. Spot rate is 3.0620 plus basis point 0.0020. So for 1 month forward rate is 3 0.0640. We add the point because bid point is smaller than the ask point. If you look at here, bid point is smaller than ask point. So we have to add. Okay, let's look at the 3 months forward rate. If we look at here, the bid rate is greater than forward ask rate. So we look at here 3.0620 minus 0.0075. Okay, so this is you will get 3.0545. Okay, you have to reduce to deduct the point because the bid point is bigger than the ask point. The forward rate is at discount. For this one is at premium. Okay, similar to ask rate, we will use the ask rate 3.0648 plus 70. So you will get 3.0718. And for 3 months forward rate, because of bid is greater than ask rate, so we have to minus 3.0648 minus 0.0020. So you will get 3.0628. Okay, so this is the point rate. Either it is premium or discount. You have to compare between the bid rate and ask rate. Okay, the difference between the forward rate and spot rate is known as swap point. In this difference, forward rate minus spot rate is positive. It is known as forward premium. A negative difference is termed as forward discount. Okay, I hope you will understand, but never mind, take some time to understand how it works. Let's look at the calculation of forward premium or forward discount. The first one, forward premium or discount, how to get forward rate minus spot rate. To get the percentage of premium or discount, forward rate minus spot rate divided by spot rate times 360 divided by forward days times 100%. Let's look at the example. For example, Kuala Lumpur quotation of Malaysia ringgit per US dollar. We have spot rate, we have 30 days forward rate and 90 days forward rate. Determine the forward premium point and forward premium annualized for both 30 day. Okay, so this one is forward day. Okay, for 30-day forward point, okay, 30-day forward point, you have to deduct forward rate, deduct spot rate. So 4 point, okay, forward rate for 30 days, 4.2193 minus 4.2100. So 93 points or 0.0093. This is positive value, so this is forward premium. And for 30-day forward premium annualized, forward rate minus spot rate divided by spot rate times 360 divided by forward days times 100%. So for 30 days, forward rate is 4.2193 minus 4.2100 divided by spot rate 4.2100 times 360 divided by forward days, which is 30 days times 100%. So the answer must be 2.65%. That is for 30 days forward point. Okay, let's look at 90 days forward point. So we use the spot rate and 90 days forward point. Forward rate minus spot rate, 4.1935 minus 4.2100. You will get negative 165 point or 0.0165. This is the negative one, the forward discount. For 90 days forward discount annualized, the amount of forward days is based on this. So forward rate minus spot rate, 4.1935 minus 4.2100 divided by 4.2100 times 360 divided by 90, because it's 90 times 100%, so you will get negative 1.57%. Okay, so this is how we calculate the forward premium or forward discount. Okay, let's do some exercises. Given spot rate 1 month and 3 months for Malaysia US dollar, Malaysia per GBP, Singapore per US dollar. Let's look at the question. Find the 1 month and 3 months outright rates for all pairs of exchange rates by using the information given. Okay, so identify the bid and ask. Okay, if the bid greater than ask rate, you have to minus. For this one, also you have to minus, and this one also you have to minus. For this one, you have to add, and add. So let's look at the answer. Okay, the 1 month outright rates for Malaysia US dollar, for Malaysia GBP, and for Singapore dollar US dollar. So, as I told you, for 1 month, the bid rate is bigger than ask rate. So you have to deduct the spot rate, deduct the point. So 3.0080 minus 0.0075, so you will get the answer. So this one is the answer for each currency for 1 month outright rates. And for 3 months, because of the bid rate lower than ask rate, so you have to add all this for the spot rate plus the basis point, so you will get the 3 months forward rate for Malaysia US dollar, Malaysia GBP, and Singapore US dollar. It's easier, right? Okay, the second question. Determine the amount of Malaysia ringgit Encik Zainal would pay today in order to buy 600,000 US dollar. Okay, determine the amount of Malaysia ringgit Encik Zainal would pay today in order to buy 600,000 US dollar. So, Encik Zainal would buy 600,000 US dollar. To answer this kind of question, always identify which is home currency, which is foreign currency. Whether to use bid or ask rate, look at what we shall do with the foreign currency, not home currency. So for this one, for Malaysia ringgit and US dollar, home currency would be Malaysia ringgit, foreign currency would be US dollar. So, determine the amount of Malaysia ringgit Encik Zainal would pay today in order to buy 600,000, meaning the bank will sell US dollar to Encik Zainal. So, they will use as rate for the spot rate. Okay, let's look at the answer. Buy US dollar 600,000 today, which is spot rate. So bank will say and will sell use as rate, this one. So 600,000 times 3.0095, Cik Zainal would pay 1,805,700 in order to get 600,000 US dollar. Okay, third question. How much GBP needed to get 1,500 today? Okay, so again, for this one, home currency is Malaysia ringgit, foreign currency is GBP. How much GBP needed to get Malaysia ringgit? So the seller, the customer need to buy 1,500 and to buy GBP. How much GBP needed to buy 1,500. So this one is foreign currency, is GBP. So bank will buy the GBP. So this customer sell GBP today at the spot rate. So bank will buy and use the bid rate for the spot bid rate. Let's look at the answer. So Malaysia ringgit 1,500 divided by 4.7745 equals to GBP 314.17. So here to convert Malaysia ringgit to GBP, so we have to divide. Okay, so GBP 314.17. And the last question, if you have Singapore dollar 2,300, find the amount of US dollar you will get in 3 months' time. Okay, so this one, home currency and foreign currency. Find the amount of US dollar you will get in 3 months. So you will use this rate. Okay. So you want to buy USD. Okay. You want to buy foreign currency. So bank will use as rate. Okay. Bank will use as rate and 3 months. We have calculated the as rate for 3 months. So we use this rate 1.2600. You have Singapore dollar 2,300 and the rate is 1.26. In order to get US dollar, you have to divide. So 2300 divide 1.26, you will get US dollar 1825.40. Okay, for similar currency, you have to divide. For different currency, you have to multiply. Okay, try by yourself first and compare with this answer. Take some time to understand this part, this exercise. Okay. Still use the same answer. Next question. Calculate the bid-ask spread for Malaysia ringgit, US dollar, Malaysia ringgit, GBP today. Okay, today, so we use spot rate. Okay, this one is spot rate, spot rate, spot rate. So Malaysia US dollar, this one, and this one. And Malaysia GBP, this one and this one, for the spot rate. So 3.0095 minus bid rate 3.0080 divided by us rate 3.0095, so you will get 0.49498%. For Malaysia per GBP, 4.7770 minus 4.7745 divided by 4.7770 times 100%, so you will get 0.052. Next, calculate the 1 month bids as spread for Singapore dollar. So you have to use this rate, ask price minus bid price divided by ask price times 100%, so you will get 0.3596%. Another question, find the annualized forward premium discount for 3 months Malaysia ringgit per GBP bid and offer rate. Okay, for 3 months, so you have to calculate for 3 months rate Malaysia GBP. So 4.7790 for bid rate minus spot rate 4.7745 times 360 divided by 90 days because 3 months. So you will get the answer for bid and ask rate. Okay, for the next question, if Encik Zainal has 50,000 today, how much GBP would he receive? So today, so you will use Malaysia ringgit per GBP. In this case, we need to calculate cross rate. Oh, sorry. So for US dollar and GBP, but we don't have US dollar per GBP. We have Malaysia USD and Malaysia per GBP. So here we will have the many unit side. Okay, cross rate for USD GBP. So USD GBP home currency over foreign currency. Encik Zainal is buying GBP, therefore bank will sell GBP, use as rate. So US dollar GBP, this one is home currency, this one is foreign currency. So this is the answer. For us rate, as foreign currency, which is 4.7770 divided by 3.0080. This one is bid home currency. So the answer would be USD 1.5881 per GBP. He has US dollar 50,000, so he buys GBP, bank sells. So bank sells at 5881. So similar currency, you have to divide. You will get GBP 31484.16. Okay, for the next question, next exercise, calculate the 3 months rate for the Singapore dollar in Malaysia ringgit. Okay, Singapore dollar in Malaysia ringgit. So it means Malaysia ringgit per US dollar. So you have to find the cross rate Malaysia ringgit per US dollar. for 3 months. This one and this one. So we will use cross rate for one side unit. Okay, common currency is one side unit. So this one for bid rate, bid home currency. This one divided by as foreign currency. This one. So you will get Malaysia ringgit 2.3897 per Singapore dollar. And for the US rate, you will get this one. And bid foreign currency 1.2575. So you will get 2.3968 per Singapore dollar. And the last one, find the amount of Malaysia ringgit he would receive if he sells Singapore dollar 67,000 for delivery in 3 months. So you will use he would receive if he sells Singapore dollar. So sell Singapore dollar, you have to use bid rate for 3 months. Okay, so for bid rate 3 months, this one 67,000 times 2.3897 because different currency, Singapore dollar and Malaysia ringgit. So you have to multiply and you will get Malaysia ringgit 160,109 ringgit and 90 cent. Okay, it's quite tough. Take some time to understand what we have covered for today. Okay, for more understanding, please do the question July 2017 question 2, June 2019 question 2, and December 2016 question 2. And we will discuss in the tutorial class. Okay class, that's all for this video.